During the press conference, Fed Chair Powell cited the real reason. He said interest rates need to continue to rise. Listen.
We do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now after not turning at all for a year and a half. Now it seems to be turning. But there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Okay, so it's no longer about high prices of everything we buy in the grocery store. It's about labor, wages, services still remaining sizzling hot. Joining me now to fight it all out, Euro-Pacific Capital chief economist and global strategist Peter Schiff and Nat Alliance Securities' Andy Brenner, who says today could be the last hike in this rate tightening cycle if one piece of economic data cooperate. Let me start with you, Andy. Your gut reaction here on what Jay Powell said and the tone he took. Hey, we're in it still. We're not jumping the tracks.
Liz, he came off very hawkish, very different from where he came off November 30th at the Brookings. As we look at the market, as you just pointed out, both equities as well as bonds, they're not believing him. I mean, the 10-year spike from 348 to 355, and now it's at 347. The 2-year that you just mentioned moved from 418 to 430, and last I looked, it was back to 421. The equity market's reversed. Look, this is a Fed that 1 year ago today projected that the Fed funds today, December 22nd, would only be 90 basis points. They're 4.25 to 4.5. This Fed is awful in their projections.
Oh, boy.
Do I think they're going to continue to raise rates? It does look like they might try to raise again, but I'd really like to see the next CPI number, and I really think the Fed is well over their skis at this point.
So it's that CPI number that we are expected to get in January for December that Andy Brenner says if that comes in super soft, maybe we might see a pause. Peter Schiff, what jumped out at you the most as the most important part of this news conference?
Well, Powell said that the consumer would be in for the most amount of pain if the Fed failed to act and let inflation run out of control. Well, I got news for the consumer. Inflation is already out of control. The Fed failed to act. In fact, the actions of the Fed created the inflation, and it's going to get a lot worse. And Powell is looking at wages rising and thinks that might push up inflation. No, rising wages don't cause inflation. Inflation is what's causing wages to rise. Wages are just the price of labor, and prices are going up. And eventually the Fed is going to stop fighting inflation when the recession gets much worse. And in fact, when it becomes a financial crisis.
OK, but Peter, the Fed has been in a months-long firefight against inflation. Do you not see any improvement in what we have seen when it comes to inflation, at least ticking downward a bit?
No. I mean, you're always going to see an ebb and flow. But in order to really fight inflation, we would not only need much higher rates than the rates we have right now, because rates need to be enough above inflation to encourage savings again. And our savings rate is basically at a record low, and consumer borrowing is at a record high. So that is not helping. But also government spending continues to increase. Budget deficits continue to rise. You're not going to fight inflation unless you get cuts to government spending. Right now, we're getting stimulative fiscal policy coming out of Washington. So everything is screaming more inflation, not less.
Go for it, Andy. What do you think?
Well, I think one of the things that Peter's missing is the money supply, and that has been growing at exponential rates. But in the last few months, it's been starting to come down.
You're talking about the Fed printing money.
Well, basically, yes, the Fed printing money, and that is being reduced. And I do see the economy slowing down, and there are parts of inflation that have come back. But Peter's got some good points. I mean, the inflation causes wage increases. It's not the other way around. We agree with him on that. Okay. But we do see inflation being reduced, and we do see the Fed backing off from where their rate increases are projected to be.
Okay, Peter, look on the screen. Goldman Sachs, Amex are the laggards here, and those, of course, are the financials when you look at the NASDAQ leaders. Same one as yesterday, Moderna, Atlassian, NetEase, DocuSign. I mean, some of these, they're just moving totally separate of what the Fed has said or done. We have an investor audience. They want to know what to do between now and the next Fed meeting.
Well, I think you have to continue to recognize that the game has changed. We're going to be living in a high inflation environment for the foreseeable future. Rates are not going back down to zero, but they're still going to be negative in real terms. And you have to invest in real businesses that actually have earnings and pay dividends. That's why if you look at our strategies year to date, our value strategy and our dividend payer strategy have delivered positive returns so far this year in long-only portfolios because we own the type of stocks that do well in an inflationary environment, and they're going to do even better as the U.S. dollar really starts to fall because the stocks that I'm buying are not in the United States, and so their prices and revenues are not in U.S. dollars, and so they will benefit from the decline of the dollar, which is going to kick into a higher gear when I think the Fed stops hiking rates because the economy is too weak and it's got a bigger problem to worry about than inflation.
He talked about how housing has certainly weakened, but we're still seeing rents and shelter costs extraordinarily high. One of the things that I found really interesting was at a certain point during the news conference, and maybe you guys noticed this, the Dow was down more than 300 points. When Powell mentioned wages and what specifically might be the reason that would trigger a slower pace of rate hikes, I want you to listen and then you guys get to respond.
We think that the appropriate thing to do now is to move to a slower pace. And, that will allow us to feel our way and, and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
Well, so there you had immediately 100 points came off the losses there, Andy, but, not really helping that much at the moment. So what do you interpret from that?
What I interpret, Liz, is he's also very much concerned about the global economies, especially the U.S. economy. And I think he recognizes the Fed has moved too far too fast. Yes, inflation's been off the charts, but he has moved, as you just said, the quickest in 40 years. So I think he's starting to be concerned about some of the after effects, the black swan effects, and some of the things we've seen. Both Peter and I hate crypto, so that's really not a good example. But, you look at what happened to the Blackstone REIT and the Starwood REIT, and as well as private credit, and you see it in a lot of different things. There's a big mistake out there that's waiting to happen, and I think the Fed's going to have to ease into it sometime in 2023.
Peter, we've got to finish up, but what are you most worried about?
Well, I agree that the Fed is going to ease, but that's going to be a mistake. It hasn't gone far enough. The problem was it let interest rates, left them too low for too long. It already expanded the money supply so much that we haven't even had enough price increases to catch up with the previous expansion of the money supply. So even if it's growing more slowly now, it doesn't matter. There is so much inflation already in the pipeline. And the only thing that was keeping our inflation rate lower was the fact that the dollar was rising when everybody thought the Fed would keep hiking. But now that the dollar is falling, that is going to add fuel to the inflation fire. I think it's going to burn a lot hotter in 2023, but the economy is going to cool off even more as inflation heats up. And that is a no-win situation for the Fed and for the country, unfortunately.
Well, the central bank does not have a good record here, you guys. I mean, let's say the economy fell into recession 9 of the past 12 times that the Fed tightened monetary policy. Guys, we got to run. It is about 32 minutes before the closing bell rings. Check the Dow, still down about 147 points.